Welcome in, and thank you for joining us for another episode of Healthy, Wealthy, and Wise Retirement. Your host, Lauren Sherman, is a certified financial planner and owner of the flat fee firm Integrity Wealth Management. He curates each episode with you in mind. Whether a work-optional lifestyle is on the horizon or you're already there, this show has something for you. With that, listen in, and I hope you enjoy the show.
Welcome back for another Healthy, Wealthy, and Wise Retirement. And welcome back to the conclusion of my conversation with Steve Blackwell of Invito Energy Partners. If you missed part one, you will probably want to jump back an episode and listen to that one first, as we talked about oil and gas solely from an investment perspective. So for today's episode, we discussed the unique tax benefits of oil and gas, which have truly stood the test of time, dating all the way back to the 1950s. And I also want to reiterate that this type of solution is not right for all investors, but for those portfolios where it is the right fit, the tax benefits are really what take this from just potentially being a good strategy to a great strategy, once again, for those specifically needing to reduce their taxable income. And then we wrap up with a few listener questions and finally, where to get started if this piques your interest. So with that intro, let's jump back into the conversation, part two with Steve Blackwell. Well, let's jump into the tax aspect, because I think that's kind of what people who have historically learned about oil and gas, that's a lot of times what leads the conversation. And I guess once again, before I get into any specific questions, maybe you can just kind of give us an overview of how did the tax benefits work? And I'm a little interested in, the history of it too is a little interesting.
So, think about, what does Congress do, right? When Congress wants to incentivize, Congress will literally tell you where they want you to put money, right? By what they put into the code through tax law, right? And so the United States historically, is around an $18 to $20 million a day consumer of oil. And typically, if you go back 20 years ago, the United States is probably a 5 million barrel a day producer. So we were reliant on foreign oil heavily in this country for a long, long time. Now that has changed over the last, decade especially, but many decades ago, they put into the IRS code incentives from capital to flow to the development of hydrocarbons in the United States because they knew we were so foreign oil dependent, right? Mm-hmm. And so through those codes and through those incentives, there are significant tax benefits that are very unique to oil and gas that were put there a long time ago. And they've just been there for decades, and they get kicked around politically every 4 years, but they don't get removed. And, I would tell you that that's primarily because there are a lot of blue states that are heavily dependent upon oil and gas revenue for their state budgets. Mm-hmm. A perfect example would be like New Mexico. I think the state of New Mexico is about a third of their budget is oil and gas revenue. If they didn't have the oil and gas revenue, they would be a bankrupt state instantly overnight. And so that's why you get a lot of political talk, but again, they don't change the rules. And so, you can use those codes and look where they put the incentives in the code and take advantage of those, and oil and gas is one of those. So, and I can go into the specifics of that now if you like.
Yeah, and it's got a really long-standing. It's been around for a long time, so it's not like this is
not a lot of audit risk,
change
right?
Tomorrow.
Yeah, not a lot of audit risk. In other words, there's already a lot of case law on this, and it's not on. I always tell people that you can easily Google, the IRS's watch list, or some call it the dirty dozen list of the IRS. The IRS will essentially tell you, hey, these are the types of transactions we're going to be looking at.
Right.
And the oil and gas, what's called the IDC deduction, and we'll get into that in a second, is not on that list. And so that part is nice as well. So
it's time tested from that aspect. We're not pushing any limits from a tax perspective.
Yeah. And so look, you want to take advantage, right? I mean, what's the biggest lifetime line item expense for any individual's personal income statement is what? It's taxes, man.
Oh, for sure.
I mean, you could have back half of the money you paid in taxes. How much better would you? I know I'd be in a lot better place than I am today, right? And so, you want to look for ways to within the rules, right? Reduce
Hmm.
that liability that you are stroking a check to the government for, and keep more of
Right.
your own hard-earned money.
Yeah.
So
So
nothing wrong
let's
with
get into that a little bit. What exactly do the tax benefits look like at the end of the day once we implement? Let's say we did just round numbers, $100,000 investment.
that.
What
Yeah,
would that do to my tax return?
yeah. So let me explain the benefits. The big upfront deduction. So when you drill a well, there are two types of cost, three types, but the two main costs are intangible drilling cost and tangible drilling costs. The only difference between the two of those is when the well is done producing, if there is no potential salvage value, it is an intangible cost.
Mhm.
If those costs expenses have potential salvage value, they're tangibles. Tangibles are things like pipe, casing, production equipment, something that you could pull out of the ground, steel, and hard assets, and potentially get some sort of salvageable value out of it.
Yeah.
So the big upfront deduction is called the IDC deduction, which stands for intangible drilling costs. It's 263C of the code. And what the code is telling you is any expense that goes in the ground that has no salvage value, so any intangible drilling cost, which is typically 75 to 85% of the total cost of a well, you can take 100% of those and deduct those in the year of investment. Okay? So let's make an easy example. If someone your example, if someone put in 100,000, it just makes the math easy. And let's say the IDCs, well, let's say our last year's fund was our IDCs were 80%. So on the K1, now we are a K1 product. You can structure these deals as direct working interest ownership and where you get a 1099. I don't think that's a good idea, but ours is a K1. So on your K1 that they would receive in March, on line 13, there would be a $80,000 number, which would represent the intangible drilling costs. That $80,000 loss flows through to the Schedule E and the 1040 as a direct reduction above the line deduction of their taxable or their AGI. So to make something really easy, if someone had $400,000 of taxable income and they put in 100 grand and they got an $80,000 loss in their K1, now they have $320,000 of taxable income.
Hmm.
So you directly are reducing. It's not a tax credit.
Mm.
Different. Key to understand, tax credits are great and they're more valuable. This is a tax deduction. So
Mm.
it's directly reducing that AGI. Similar to like depreciation on real estate. A lot of people are more familiar with real estate.
Right. Right.
And so that's the big upfront deduction. Now, for those of your clients may be familiar with passive and active income, right? So you typically have to match those up, right? If you have a passive investment that creates a loss, you can only offset passive income. This investment is purely passive, meaning in the sense that you are not actively managing this investment. You are just making the investment. But there is an exception, again, put in the code specifically for oil and gas. There's an exception to the passive active loss rules, the PAL rules, for working interest that allows you to, this is what makes it extremely unique, to take this loss that is truly a passive investment and offset
Right.
ordinary active income.
Yeah, that's huge.
And that by itself is what makes it extremely unique. So think about it. Think about all those people that have W-2 jobs. Okay, I've had a W-2 job most of my life. I mean, there was hardly anything you could do to reduce your taxable income, right?
Hmm.
So this is a great way for high 1099 people, anybody with a high W-2 job, to reduce that taxable income. Um, and
So
so, yeah,
some of the scenarios I'm thinking through, I jotted a few down, and you just kind of tell me if these apply or if you have any additional context on any of these. One would be just simply trying to bring your tax bracket down. So if we're in the 32%
100%.
bracket and we want to maybe live more in that 24% bracket, we can offset
Yeah,
income to bring our income down to the 24. Maybe we have a few years until retirement and then our income is going to drop. So we could do maybe even a layered investment over a few years to bring that income down. Does that make sense?
yeah, managing tax brackets is a great strategy.
Yeah.
You get your biggest bang for your buck by reducing those higher taxable income brackets.
If we can avoid paying taxes at a 32% bracket and pay it much lower or even
Yeah,
lower than 24 after retirement, can make a lot of sense. Um, I also had, I guess um, potentially offsetting some of the costs of RMDs could
Yep.
make sense. Roth conversion, same
Yep.
story. That's increasing your taxable income. We could offset some of that.
Yeah.
There's also something, I'm trying to wrap my head around how this would look, but uh, some people refer to it as like a widow's penalty, where all of a sudden you go from a joint bracket to an individual bracket, and maybe
Oh,
we need to,
really?
maybe we kind of need to wrap our heads around that for a couple of years before we get our assets settled. But we might, if you're accustomed to paying not all
Yeah.
that much in taxes and all of a sudden you're widowed, or same story with someone who's divorced, we're
Yeah.
gonna, it's going to be a little bit of a a hit to the side of the head when the tax bill comes
Yeah.
due if we're not
I've never
expecting
thought
it.
about that, but you're absolutely right. Those are all, I mean, any scenario where you have a significant amount of of taxable income, this potentially, it's not suitable for everybody because you have to
Yeah.
have liquidity for it. Uh, but it's a great tool in the toolbox, right? To
Yeah.
look at and consider in an overall tax plan. I would never suggest that oil and gas is the only tax mitigation strategy you're pursuing, but it certainly could be part of, you know, um, an overall strategy
Right.
is the way I look at it. So
And I think one other that popped in my head that I think you've shared in the past would be the sale of a business or more one-time type of events where
yeah,
all of a sudden your kind of routine income gets a big spike due to something like that.
yeah, you got a bunch of stock options. You're an executive, and all of a sudden you're exercising a bunch of options. Or there's a you were the business sold and you own some. Maybe you were just an employee and they did a sale and you owned a piece and you just got a big windfall of whatever it may be. Again, all reasons to look at a tax mitigation strategy and consider as part of that strategy
Mm.
maybe a piece of it being allocated to an asset like this, an investment like this, because of the significant tax benefits that come with it.
Hmm. Circling back to when you said this is certainly not for everybody, I think I can appreciate how you're not just making a blanket statement that everybody should be involved in this, because I think you've commented before that this should not necessarily be an allocation of a piece of the pie chart that everybody's just have some exposure to.
Yeah, I think for a guy like me calling on wealth managers like yourself, it would be nice to walk in and go, okay, how much are you allocating to alternative assets? You know, oh, they might say, well, we typically allocate 20, 25% to alts. Okay. Well, it would be nice if I could say, well, carve out 2% for this, right?
Mm,
I think that oil and gas has such unique attributes to it that it's not suitable for everybody. That's the way I say it that way. So it's more of a case specific. So if you're looking at you're an advisor and you have whether you're a tax advisor or a wealth manager and you have a book of business and the piece of that book of business is higher net worth or higher earning clients, this is something you want to be able to bring to the table as an option to consider.
mm.
And again, not going to be suitable for everybody or not going to fit for everybody, but you want to have it as a tool in your toolbox is the way I look at it.
Right. Um, Let me see. I've just taken a quick peek at the questions. I put out a couple of questionnaires and we got some back from people, the questions that they wanted me to ask you. Before I jump into that, actually, I was going to share my screen on this part.
And I didn't finish all the tax benefits, so we can do
We got
that.
ahead of, yeah, I was going to share this piece, but that was my question. Was there anything else on the tax side that you wanted to share before we um,
Yeah, so
got in the
this
rapid fire?
summarizes it right here, right? So we already covered the IDC, which is the one on the left, the 263C.
Yeah.
So let's call that 75 to 80%. So the remaining costs, those tangible costs I told you about, normally you would have amortized those over 7 years, but now with the big beautiful bill that just passed, you can take bonus depreciation on those and accelerate all those typically into the following year. You can only take, not to make this too complicated, but you can't take the IDCs and bonus depreciation on the tangibles in the same year
Okay.
unless all of the wells that you invested into are completely drilled in that same calendar year, which
Okay.
typically won't happen, especially in a fund that closes 12/31. Like our fund closes at the end of the year, the wells are certainly going
Yeah.
to be drilled. So on that $100,000 example, you're going to get an $80,000 write-off in year one or 75 to 80, and then the remaining 15 to 20%, you're not going to write off 100% of the investment, but let's call it about 95, could be a little bit higher. You're going to get the remainder of that next year. So you will have an additional deduction next year through bonus depreciation.
Okay.
And so those are the two big upfront deductions, the IDC and the tangible costs through bonus depreciation. IDCs is specific to oil and gas. Bonus depreciation is applicable to every industry. There is one additional tax benefit associated with oil and gas, again, put in the code to incentivize capital to flow to the development of hydrocarbons.
Right.
613 of the code, it's called the small producers tax exemption. And all this means is when you start to receive, so like if you're familiar with real estate, when you start to receive the rent, when we start to distribute the revenue from the selling the oil and gas, that cash flow that comes to you has a tax efficiency to it as well, in that you only pay tax on 85% of it. So 15% of it can flow through tax-free.
Okay.
So another
And
nice
that's another that's specific to oil and gas.
Yes, correct.
Okay.
Yep. And so those are really the first two of the two big upfront deductions, and then the depletion or what's called the small producers tax exemption. Another name for this depletion allowance is the benefit you get as the cash flow comes to you.
Okay. Yeah, and this summary of tax benefit is just one page of this executive summary. So I could link the PDF in the show notes of this episode.
Sure,
there's a little bit more info for those that like to dive under the hood a little bit more.
Yep.
Let me think if there's anything else on the tax planning side, or does that pretty well cover it?
No, I think that's the tax planning side of it. I think the next part of the conversation could be, well, then how is the income treated as it comes to you? And then when we dispose of the asset, what happens then?
Yeah. Do you mind jumping right into that?
Yeah. So essentially you're depreciating the asset up front. You're getting the ability to take that loss, offset ordinary income. Now, as the income comes to you, it'll be taxed as ordinary income. So you're going to pay ordinary income rates on it. Now it's treated as passive income, so you're not subject to self-employment tax, which is nice.
Mm-hmm.
And then of course 15% of it's tax-free. So in other words, I would look at this as a tax deferral, right? So you're taking advantage of the concepts of present value, right, and reinvestment, right? So you're going to take that money that you save from not paying, lowering your tax bill and reducing your tax bill. You're going to take that money, and hopefully what you do is with your financial advisor, you're going to go reinvest that money. Now that money's going to start making money for you. And then as the income comes along, you're going to be paying the tax at hopefully a reduced rate, because it's not ordinary active income, it's ordinary passive income, and 15% of it's tax-free. And then when we get to the end, and for us, for every oil and gas drilling fund, that can be different on when the end is. For us, that's somewhere between 5 to 8 years. When we sell the cash flow from the fund, now we're disposing of the asset. That last payment is treated as a long-term capital gain because we've just sold the asset.
Okay.
And so that's how the income's treated along the way. So for us, what we hope is the clients that are with us, if they're actively making a lot of annual income and triggering a lot of taxable income because of their job, their business, for us, what we hope is we have people that are reinvesting with every year, right? And they're building an oil and gas portfolio as part of their, not only their investment portfolio, but also their tax planning strategy.
Right.
So,
right.
Yep.
Okay. No, that's helpful. I think, yeah, so some of this is can be a little hard to grasp, even I think if people are hearing some of it for the first time. But I think that's where some of the visuals will help out, and some of the kind of Q&A back and forth that we've had sometimes with individual clients, where it takes a little bit of time to wrap your head around this. One thing that's helpful from our perspective too is that we can plug in and run different scenarios in our tax planning software, and we can see what your tax outlook looks like with or without something like this in the portfolio. And you guys have a whole tax calculator that you've built too, that you really need to just see the impact of everything.
Yeah. Again, I will say it again, your biggest line item expense as an individual, if you look at yourself as like a business, which you should, your biggest expense on your line item expense on your income statement is going to be taxes. So how do you limit that and keep more of that and then reinvest that is how you build long-term wealth. And so this is, again, not a singular strategy that solves all your problems, but certainly one that can contribute to that strategy of reducing that tax liability.
Right. Yeah, that's good. And I'd be obviously remiss if we have a lot of clients that are fee conscious. So I have to ask about the fees on this and how those, I think entering the alternative world in general when it comes to fees is a little bit different. So maybe talking about the fees specifically with Invito and then level setting of how that would compare with other opportunities, maybe like the 2 and 20 that people have heard
Yeah.
of.
Yeah, I
I
mean,
think
most
that would
people
be
are
helpful.
familiar with that 2 and 20 model of, on the alt space, 2% AUM fee, which is an annual fee based upon the capital raise, and then a 20% of the profit. So the way we structure our fund is we have two fees basically, a one-time upfront fee. So a 10% management fee. And so the reason we do that versus the AUM fee, because over time this is lower, but also when you structure it this way, it gives us the capital to run the business, but two, that management fee is considered an IDC, so you do get to write it off. So that's a big advantage. Then from there, we don't have a 20% share in the fund. We have what's called same thing, carried interest, but it's a 4% carried interest. And so we share at a level of 4% on the revenue. It's a revenue share. So in other words, when we start making distributions, 96% of that revenue is going to the clients, 4% is coming to us. When the clients get all their money back, so when return on invested capital happens, meaning not including the money they save from the tax benefits, from cash on cash. In other words, if they put in 100 grand, when they get $100,000 back, my 4 goes to 25. And so my whole incentive is to get it to that back end, right? To go from my 4 to 25. And then of course, for that 25% to be worth anything, I certainly need to get significantly past a 1-to-1 return. And so we're always looking for about a 1.75, 2x minimum total return on our investments on the low side, so that 25% is valuable to us. So for us, what we think that does is create alignment. Again, nobody can guarantee the upside, but I could sit there and I could look anybody directly in the eye and go, look, first off, we believe we're making a bet on ourselves, because a 4% share on the front side is not a lucrative investment for us, but the 25 is. But that doesn't happen until you've got all your money back, you've made money from the tax savings, and you're continuing to get distributions. And so at that
Right.
point, we are aligned together, and I'm participating at a higher more meaningful level. And so most of the advisors we work with like how we structure our incentive to be on the backside. And it's also what differentiates us from pretty much all the other oil and gas deals on the street.
Right. Yeah, I think that's helpful to talk through because we have, a lot of clients that we invest the portfolio in relatively, you could call it passive, low cost funds. So if this is, like I said, a new space for them in the
Yeah.
alternative world, it can be a little hard to wrap their head around. But I
Yeah.
think the way
Yeah.
you're describing it makes a lot of sense.
Yeah. I mean,
And
you can't compare us to a $1 billion ETF fund, right? Or a $1 billion mutual
right,
fund that's charging, whatever. I mean, that's
right,
just, it's not the same. It's not
right,
the same
right,
comparison.
right.
So,
And I like the idea to kind of use a baseball analogy. Just we're trying to hit singles and doubles rather than swinging for the fence and hitting home runs. Kind
yeah.
of, I guess, circling back to where we started the conversation with that tier one drilling
Yeah.
versus 2 and 3. If you
Yep.
don't mind, we'll jump into a couple kind of rapid fire questions that came
Sure.
in. Um, Let me see. Some of these we may have touched on already. Um, yeah, I think the first one was I've invested in alternatives in the past that did not work out. How is this different? Sounds like, a lot of that relates back to that tier one drilling and reducing the
Well,
risk as much as we can.
I would answer that question this way. Most of the alternative assets or private placements that I see on the street or people have gotten involved with always have two problems. The first problem is always the same. The fee structure is always is structured in such a way where the fees are so high on the front side that performance doesn't matter. In other
Mm.
words, the sponsor is going to make good money regardless of whether the asset ever performs.
Right.
So everybody has to make some money to do this, right? I mean, you have to have
Right.
money to pay to do this. And this is not, again, this is not an ETF or a mutual fund. It's not even remotely the same comparison, right?
Right.
But when the fees are so high, meaning that I've seen deals where they're 15, 20, 25, 30% in total fees in the front side, right? And or their carried interest in the fund is 15 to 20% from dollar one. They're making money regardless if the fund ever performs. So those are the things you have to watch out for. And then of course, oil and gas specifically could be the types of assets that you invest into. But you just want to look for alignment. At the end of the day, the biggest assurance I can give somebody, because nobody can guarantee that it'll perform, but is how do I make money? How do I really make money?
Yeah.
Well, I
Where the
really make my
incentives are
money when I
aligned.
go from 4 to 25. Not that I don't
Hmm.
make any money up front,
Right.
but this is a lucrative business for me and my partner and our team if we can get fund after fund to that back end.
Yeah. Yeah. I think the past world too, kind of the broker dealer world, if you want to call it that, there was a lot of it's just kind of slinging funds or slinging opportunities, a lot of sales pitch, I guess you could call
Yeah.
it, where not at all what you've talked about today, where it's like, hey, this is not a great fit for everybody. It has to be an individual solution and not just spraying it out there to
Yeah.
everybody
Well, the
and seeing what
outsized
comes back.
returns, you don't hear me pitching. I mean, and some people, 1.752, some people might go, that's not very good. Okay, well, that's fine. I mean, it could be
Right.
higher, but it'd be really easy for me to come out here as an oil and gas guy and tell you 3, 4x. You'd have no
Hmm.
idea. You would have no ability to do due diligence on that. And a
Hmm.
lot of people do that, but it's not realistic. It could
Yeah.
happen, but the
Yeah.
probability of that happening is not statistically high. A lot of things have to go your way. And
Yeah.
so, again, any types of the private placements or the alts when they're promising really high returns. I mean, maybe it's true, maybe it's not, but it helps you raise capital.
Yeah. That's
But they
fair. That's
promise
true.
really high returns.
Right. That's true.
Yeah.
That's
I'd
right.
rather under promise and over deliver.
Yeah, for
Sleep
sure.
well at night. Yeah.
Right. This next one, I guess it says, what's the minimum and maximum I can invest? We're probably more looking at the minimum than the maximum, I'm assuming. But
Yeah,
how would
there
you
is
answer
really
that
no
one?
max, other than your personal scenario, but the minimum is 50 grand. Our units are 100, half units minimum, and then you can increase by 25. So 50, 75, 100,
Okay.
125, et cetera. Yeah.
Okay. Um, can I put part of my 401k into this, or does it have to be money that I've already paid taxes on?
You can invest qualified money. I don't suggest it. And the reason why I don't is because you lose all the tax benefits won't apply to you. And so
Yeah.
not that that's the main reason to invest, but that is a nice piece of the investment. So
Yeah.
if it's, I'm not the financial advisor, you're the financial advisor, but I would say, hey, take your qualified money and put it into a different asset and take, if you have, a non-qualified funds, put it into an oil and gas deal so you can take advantage of the tax benefits that come along with it. So the answer
Right.
is yes.
Okay.
And I'm not telling someone no to do that, but I would say that I wouldn't do it.
Yeah,
So
I would tend to agree with you. I think a lot of the alpha, if you want to call it that, that
yeah.
comes from the opportunity, comes from the tax benefit, and you're losing that in that aspect. And I guess more specifically to answer this one, you answered it maybe more from the qualified versus non-qualified perspective. Specifically for the 401k, there probably would be a lot of limitations on what 401ks would allow. I guess that's going to be company specific of if they allow you to invest that way or not.
Yeah, you probably have to have it in uh,
It'd have to be like
self-directed,
separately
self,
managed,
a self-directed
self-managed. Yeah.
account,
Yeah.
again.
Yeah.
And then of course it's going to you probably have the worry about AMT or not AMT, but UBIT with an oil and gas deal, if you were to do it. So I don't, qualified doesn't make a lot of sense to me, but again,
Okay.
you know,
Yeah, I think we're probably on a consensus on that.
yeah.
I guess you touched on this, maybe if you want to add anything, does the price of gas impact the return? If so, how?
Yeah. So the price of either natural gas or oil, because our wells will have revenue streams off of both. Well, absolutely. That is the largest, obviously, indicator that's going to affect the performance of the fund. If
Yeah.
it's,
And you talked through that a little bit.
yeah,
Yeah.
if your oil prices go down significantly or gas goes down significantly for an extended period of time, it's going to affect it. Conversely, if it goes up, same thing.
Yeah. Um, oh, if I have a higher income and I'm still 5 years out from retirement, is this something that I can do each year until I retire to offset my income?
We hope so.
So essentially laddering that and saying, hey, I don't want to be in this 32%
Yeah,
bracket. Get
yeah,
me down to the 24, but I have 5 years to do it.
yeah.
Instead of thinking of it as a one-time thing,
That's what I
more of
mentioned
a
earlier, right? We're hoping that those clients that are continuously kicking off a lot of income will kind of in this case, over the next 4 to 5 years, they would have a nice oil and gas portfolio. And then if they,
right,
they're done working in year five, from there, they're just going to have, just a bunch of revenue coming off, a bunch of
right.
passive income flowing to them, mailbox money from these investments.
Yeah. And that from that perspective, maybe this is more a question that I would ask myself in the mirror, I guess, as a financial advisor of what percentage of a portfolio are you comfortable putting into something like this so that it doesn't start to drive the portfolio too much and it's just an aspect of it. I guess I kind of have my own thoughts on that. Do you have any thoughts on your end regarding percentage of portfolio?
I mean, I am not a wealth manager. I mean, I would look at that from the macro of alts versus not alts.
Yeah,
So I mean, I think that, a lot of people are very comfortable with, that 15 to maybe as high as 30% in the alts category.
right.
Um, I personally am higher than that, but that's just me. But then inside the alternative scenario, what percent would be oil and gas? I can't imagine it would be more than a 5 to 10% allocation inside of that.
Gotcha. Yeah,
So no.
that
So
makes
your
sense.
overall portfolio, I wouldn't, think that you're not gonna want to go put 30% of your portfolio or 25% of your portfolio purely into oil and gas. I
Yeah,
would think that that would represent a very well diversified, um, structured portfolio. But again,
right. And I know that one's a little
that's
unfair.
why I like working through wealth managers because that's
Yeah,
your job.
yeah, that one's a little unfair. I'm kind of asking you to put on a financial advisor hat that's not exactly your what your job is, but
But
uh,
I'm realistic about it, right? Because I think
yeah,
about it from my own personal perspective. I don't think that I think that that's probably somewhere in that range. I don't
okay.
know. Maybe I'm
Uh,
off, but that's what I
I
would say.
guess one of the kind of as we start to wrap up, obviously next steps if someone did want to invest or at least more deeply explore one of these opportunities. From my perspective, I guess I'm speaking maybe more to the audience than you right now. We would send you an invite via email where you would be able to have access to all of the information about the opportunity. You'd be able to do your own due diligence if you'd like. You guys have full transparency of everything, the financials and everything that you can look at. And then if we did, essentially, in this digital age that we're in now, it's essentially filling out
Yeah,
an application
online.
electronically and
Yeah.
doing it that route.
They just filled the subducts online, and so they would get access to the data room, and in the data room is all the due diligence documents. And then to invest, they would just, you know, it just takes you 10 minutes to do it online.
Okay.
And of course,
Okay.
as I've told you, if you have a client that wants to do a one-on-one with me, you and me and them, and they want to get on a Zoom and ask me direct questions, I'm happy to do that as well.
Okay. Yeah, we appreciate you making yourself available for those
You
conversations.
have time. The beauty about oil and gas is you still have time to get a 2025 write-off. I mean, you can literally invest up until the
Yeah.
31st. I don't suggest you wait that long. I will be here on the 31st until the last wire cut off. It's every year. People are trying to get into last minute, but it's one of the very few
Yeah.
things that you can do at the last minute and still qualify for a 2025 deduction.
Okay. So you're saying I should probably get this podcast episode out sooner rather than later so that people have
It
an
wouldn't do it.
opportunity
It
to
would
listen
do
to
no
me.
good to put this out in January.
Yeah. Right. Well, plan for next year, I guess, if worst
Yeah.
case scenario. But um, yeah, we've covered a lot, and I think hopefully from my vantage point, you did a good job of making everything pretty clear. But I'm going to include a couple of resources with the episode. Anything that we did not touch on that you think would be helpful, or anything you'd like to add to the conversation?
Not that I could think of. I think that, if hopefully we dispelled some of the, um, maybe initial, I'm unfamiliar with this, or I've heard this is really, really risky. And my answer to that is it can be if you invest in certain types of assets. And hopefully I articulated enough to you in a way that that's not what we do here, and that we also structure our fund in the sense of where our incentive is really on the backside. And it would do us no good to get into really risky assets as well. So I think if you're in a bucket of looking for alternatives to the market, and you also have some large liabilities from the tax side, this is a great conversation for you and Lauren to have about whether this is a fit for you.
We touch on circling all the way back. I think I mentioned timeline, right? Of like, are we thinking a 10-year timeline, a 6-year timeline? What's the most common if someone said, hey, I have this chunk of money, I'm okay, quote unquote, locking it up for a period of X number of years?
Yeah, 5 years is the longest we'll be in it. The shortest we'll be in it, and then we'll exit somewhere between year 6 to 8. And so, but obviously, the return of capital starts to happen pretty fast, right? So we'll, second to third quarter after the fund closes, you'll start to receive cash flow, and we're targeting a total return of capital somewhere right around year 4. So once you get to that point, it's just return on top of that, and that doesn't include the fact that you made money up front from saving on the taxes.
Right. Perfect. Well, I think that's a good spot to wrap. You know what? Actually, I asked you this last time, but I think it was an interesting enough, if you want to share it with our audience. People are seeing your face right here on the screen, and behind you is that a hockey picture. Do you want to share more about that as we close up here?
Well, I'm originally from Illinois, but grew up mostly in Michigan, and didn't become a hockey fan until I moved to Michigan. So I'm a big Red Wings fan, and that is the old production line. It was called the production line from the 60s and 70s. All 3 of those guys played on the same line, and they're all in the Hall of Fame. So it's Sid Abel, Gordie Howe, and Ted Lindsay. So that's actually a painting, not a picture, which is pretty cool. And so
that's right.
That's the old school production line from the 60s and 70s. So that's the story behind that one. And I bought that, believe it or not, when I moved to Denver. I moved to Denver when I was in my 20s, and the Avalanche had just moved there, for any hockey fans on there. And I bought that at an Avalanche game.
Cool. That's a good background. I don't have much for story pieces in my background. That's just all the designations and stuff.
I said your background looks way better than mine. It makes you look more professional. And
yeah.
I got a hockey picture behind me with guys with no teeth.
Yeah, right. Well, I spend an awful lot of time at my home office, so this is the background that I get.
So,
well, awesome, Steve. I really appreciate you sharing your time and your expertise with us today. We'll definitely maybe not have you back necessarily since you've told your story, but maybe have you jump on some one-on-ones if anybody wants to have
happy to do it.
One conversation. And then other than that, I always close with any listeners out there can find past episodes at integrityguidance.com. Just visit the podcast tab. And, I say typically we'll be back in 2 weeks, but I've been off on the podcast realm a little bit. So maybe we'll see you when you see you with the next episode, I guess I could say. So Steve, thanks for joining, and God bless, and have an awesome Thanksgiving coming up, and we'll talk more soon.
Yeah. Thank you. Happy Thanksgiving.
All right. Thanks, Steve.
Take care. Bye-bye.
Thank you for listening in and supporting this show. And if you have a moment, we'd love a 5-star review to help this podcast reach even more listeners. Also, this show thrives on feedback from its audience. So if you have any topics you'd like to hear covered, or have anyone specific you'd like to see join the show, please email your recommendations to our address, hello@integrityguidance.com. That's hello@integrityguidance.com. We review every email that comes in, and we will do our best to include any recommendations you have for us. Thanks again, and be sure to follow our show so you don't miss an episode. This podcast is for entertainment and informational purposes only and is not intended as specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and owner of Integrity Wealth Management, a flat fee firm which serves pre-retirees and retirees in search of their own work optional lifestyle.